Hi everyone, my name is John Windy and I'm really excited to introduce this second module of our training courses on finance management. So remember our first module that has just ended, we focused on understanding your income, your expenses, how to manage your saving, and how to, and we also introduced investing. So this second module, we're going to cover introduction to debt and also getting out of debt. So this course focuses on the introduction bit to the world of debt, or how to manage your debt. Okay, now let's introduce this topic. We help you understand debt, and we help you understand among our objectives for this course is to define or help us understand more about what is debt, and also differentiate between a good and bad debt. Okay, and also the factors to consider when taking up a loan, the risks of borrowing, and the components of debt or a loan, and the warning signs of debt getting out of control. Now let's begin by defining what debt is. Now debt refers to what you owe when you borrow something in cash or tangible goods from someone else, or when you purchase something on credit, then that is called debt. So if you buy something on credit, or once you use your credit card to buy items or to purchase some items, then that is called debt. Okay, so debt can either be in cash or in tangible goods. Note, now for the borrower, the loan is a liability, that is a sum that is owed. This debt must be repaid regardless of income or cash flow. So one thing that you should know is, if you've never taken a loan, when you take up a loan or your loan is approved by a financial institution, then that loan must be repaid regardless of your income. Okay, so it's a commitment that you undertake when you're taking up that loan, that I have to repay this loan. Okay, so whether you're employed, or if you are employed and it was based on a salary as the source of repayment, or it was a business loan which dependent upon the turnovers to repay the loan, then it's a commitment that once you take that loan, then you'll pay it to the letter. Okay, so credit refers to the ability to borrow, or the sum available for borrowing. So that is the credit, or the amount that is available for borrowing. Now let's give. I love giving stories because they were my eye openers into getting all these topics and also these courses running, and helping somebody also not to go through the pain of learning through experience. If you get this information, then you will be able to do a proper analysis when you're taking up a loan or a facility from a bank. Now that reminds me, still takes me back to when, after I graduated, I got my first job, and after I received my first paycheck, then I could qualify for a loan. I remember the first loan that I took was 100,000 shillings, and what did I do with that money? Remember, you're fresh from college and you've just graduated, and now you've gone, you're now working, and you've rented a house. So my first 100,000 was, I spent it on household goods. So I bought electronics, to be specific. That was electronics, a big TV, home theater, and some other accessories. Now, I did not really understand that after taking this loan, it was a commitment that that loan had to be paid. Okay, so I knew I was still working, so my employer would deduct from my salary and remit to the bank. Okay, and I remember it reached a point that the employer was undergoing some financial crisis, and at some point, then we were all terminated on the basis of the company did not have sufficient working capital to keep the organization running. So what happened is you have a loan that is still running with the bank, and you don't have a paycheck, and you're left there. You could have taken I didn't really understand that it's a commitment that regardless of that termination, I had to pay that loan. Okay, somehow affected my score, but I thank God somehow I managed to clear my debt. But this course is designed to help you understand what is debt and the implications of having a debt, or consequences or the risks that you expose yourself to when you're taking a loan. I'm not saying that a loan is bad, but we'll cover more details on differences between good and bad loans or bad debts, and also the second module, if you're in debt and you need to get out of debt, then there's a course that gives you more details on that. Now, why do we borrow? Okay, like for my case, after I graduated and I got my first job, I took up a loan of 100,000 and bought electronics. I bought a TV, I bought the home theaters and a cell phone and some other gadgets here and there, because I borrowed that money because I thought I needed. That's what I needed by that time. But why do we borrow? We borrow in order to invest. Okay, I remember banks during IPOs also financed many people to buy shares. So you can take up a loan in order to invest or to respond to an unexpected emergency, or to consume or purchase an item for which we do not have enough money at the time of purchase. That was me. Okay, so there are several reasons, or there are various reasons as to why we borrow money from financial institutions or even from friends. Okay, so these are just among a few, but a few reasons as to why we borrow money. Now, you need to know the risks of borrowing money. It's important that you understand that debt is a risk. And if you can't repay your loan, there will be consequences. Even with careful planning, you may have problems making loan repayments. For example, when your income is interrupted due to illness or necessary absence, okay, if your income is interrupted, then you might end up having problems making loan repayments. When the investment of the loan results in a loss, okay, then still you may have problems making the loan repayments. When your household and business expenses are greater than your income, then you might have a difference paying up the loan. Remember, maybe you borrowed that money to boost your working capital, and you find it reaches a point that the business is not able to generate enough income even to repay the loan. So when your household or the business expenses are greater than your income, then you may have problems making your loan repayments. When unexpected events create an urgent demand for cash, such as, for example, paying doctor's expenses, funeral costs, etc., these ones can also cause problems and you might have problems making the loan repayments. Okay, let's look at examples of debt. Credit card debt. Remember, when you buy something on credit, then you enter the world of debt. So credit cards is an example of debt. Car loans. If you purchase a vehicle and you're financed by a bank or a person, and you've not bought it in cash, you've bought it using borrowed funds, then that's an example of loans. Student loans, like the higher education loans board, which I'm still repaying currently, then that's still a loan. Okay, home equity loans, mortgages. These is another example of a loan. Business loan, be it a working capital loan, LPO financing, that is local purchase order financing. All these, they are business loans. Personal loans. If you're salaried and you're given a loan by a bank to be paid either on check-off, that is where a scenario where the employer remits your repayments on your behalf, or where the money is deducted directly from your accounts with the bank, that's a personal loan. Loans from friends and families. So if you've taken a loan from a friend or from a family, that's an example of debt. And the last one, if you have prepaid bills, you consume them, you have to pay, then that's a debt. Okay. So when you purchase something on credit, or you've used something and you have to pay at the end of the month, be it telephone bills or maybe electricity bills, that's debt. Let's look at the types of debt. We have we're looking at two basic categories. One is good and bad debts, and the other one is secured and unsecured debts or loans. Let's look at a good debt. A good debt is an investment that will grow in value or generate long-term income. If you take a loan from a bank and you put up an investment, remember, an investment generates money or generates income in your absence. That's an investment. So a good debt, we can call a debt. It's a borrowing, yes, but you've put money in an endeavor with the expectation of making more income. Then that is a good debt. For example, education. Okay, that's what I'm using right now. I had that loan. I took up that loan from my education loans board here in Kenya, and that is now what made me who I am today. So that was a good debt. If you take up a loan to start a small business, or to start a business, then that's a good debt. Stock market. If you're financed by a bank to buy shares, okay, then that is a good debt. But you have to be very careful, because a good debt can turn out to be a bad debt if it's not well managed. Okay? If you take up a loan and set up a small business and you've not done your research well, and then you're not able to monitor or manage that business, then it can turn out to be a bad debt. Okay, so these are examples of good debts. And the other example here, we have rental houses. If you build up some rental houses, this is an investment because it's generating income, and you've put up the units and they're generating income, then that is a good debt. So ask yourself, is the loan that I'm intending to take, is it a good investment? Okay. Let us look at the bad debt, so that you'll be able to compare both. You will be able to compare good and bad debt. For example, you've bought a car for your personal use. Okay. Remember, that car has a cost price, has depreciation, that is, it's losing value. You have to pay insurance for that vehicle. You have to put gas to that vehicle. You have to meet the maintenance costs for the vehicle. So, and at the end of it, let's look at maybe after 1 year, you'll not be able to sell the unit at the price, or the buying price, or the price that you bought that unit at. So, is it a good debt? Okay. If you're using it for business purposes, or if the main purpose of buying the car was to boost your business or to generate more income, then it can be a good debt. But if it goes to that side, then you're paying for the gas, you're paying for the rent, you're paying for the insurance, and it's an element of depreciation, then that's a bad debt. Clothing. Remember in our first course where we had the first module where we addressed managing your income and managing your expenses. If you're not wearing it out or using it up, then that can be a bad debt. Because remember, this is not an investment. Okay? If they're not generating income, it's not an asset. Okay? It's a liability. Okay, let's look at credit cards. Okay. Credit card means you're using an inverted cash flow. Okay, you have a limit already loaded that you can utilize. So the credit card in itself is an inverted cash flow. That is, you are using what you've not earned. So you use first, then you make the payments. So anything that you buy using a credit card is a credit purchase, which means you have to pay, and you'll pay with interest, okay, and the minimum amount that you're supposed to pay is on a monthly basis. So, but again, if you look at a credit card, if it's well managed, it can help you, okay? But if it's not well managed in itself, it's an inverted cash flow. You're using what you've not earned, okay? Because there are some credit cards, you get a lot of loyalty points that maybe you can earn some bonuses or cashback or trips or vacations. So if they're well managed, if you pay within the credit-free interest, the interest-free period, then it can be considered as a good debt. But the best practice is you need to save for what you want to buy. If you can buy, you need to manage. You need to be very careful when you're using this debt. Okay, when you're using these credit cards, you need to know the interest, the dates when you're supposed to make the payments, and you need to do proper planning and budget. Because if you're shopping for, if you are an impulse buyer, then with these cards, you might end up in a dip. However, there's of course also a future course on getting out of debt. How do you get out of debt of credit cards and the other debts? So still another course, but this one in itself is just highlights that a credit card is simply a limit that you've given. You've not earned that cash, but you have to pay, and there is an element of interest pegged to that purchase. So bad debts do not generate long-term income. Okay, bad debts is incurred. The debt is incurred to purchase things that quickly lose their value and do not generate long-term income. Let us look at secured and unsecured debt. Okay, so we have the unsecured debts and the secured debts. So let us look at secured debts. These are loans such as, let's say for example, a mortgage. Okay, the house is there, which acts as security for that loan. If it's a vehicle and asset financing, the asset itself is held as the collateral for that loan. So, for secured loans means, yes, you have to make your monthly repayments, but in case of default, then the bank or the financier can come and repossess the unit. Okay. Now, for example, the mortgage that I've just explained, collateral in this case is normally the house itself. Guarantors, or a situation where guarantors, or you've been called upon to provide guarantors, people who can stand in or step in to make your repayments in case you find yourself in the difficulty of making the repayments as required. So secured loans are backed by a security. Okay, so there's something that can be repossessed and sold by the financier to recover the amount of loan outstanding. Let's talk of unsecured loans. Most of these loans are like the salary earners scheme. Okay, there is nothing tangible or security that is attached to that loan, or the loan has no guarantors. There are no people who can be called upon to make the payments for the loan in case you're unable to make the minimum or to pay off your loan. So for the unsecured loans, basically most of them are salary based. Okay, and there is no security attached to it. Okay, no guarantors, no security. Okay, let us look at the costs of borrowing, or the related cost, or the cost that comes with debt. Now, this one can be categorized into two. And the first one, we have direct costs. These are costs included in the loan package directly. Okay, so you have your loan, you've applied for the loan, it has direct costs, and these costs are like the interest charged. Remember, for any loan, the financier is in the business of lending and he expects to make income from that. So there's some interest charged to that loan. Normally it's a percentage, or it's a margin that you're supposed to pay on top of the loan amount that was advanced. Then there is the loan processing fee, also called appraisal fee. Other institutions call it the processing fee, arrangement fee. So it has various names, or arrangement fee, but it basically means this is the cost that the financier charges you to process the loan. Okay, and this charge is normally deducted from the loan that you've borrowed. And there's also insurance. Okay, most of like the unsecured loans, there's an insurance aspect to that. Okay, in case maybe a permanent disability or a death, then the insurer can pay off the loan. So for properties like assets, like let's say a mortgage or a vehicle, let's look at mortgages. Mortgages need to have insurance, the personal insurance, in case of permanent disability or death. Then the insurance company can step in and make the payments, and you also get the insurance cover for the property. In case the property is damaged, then the insurance company can step in and repair, or can step in to cover the property damage costs. Okay, there is the stamp duty. This goes to the government. So these are direct charges which are pegged on the loan. So these are the basic things that you need to know as direct costs for the loan. There are also legal fees. Normally this one comes with, for example, the mortgages, where there's some transfers involved. Remember, there's ownership here and some agreements that have to be made. So legal fees is also a direct cost. So look at this whole cost. There is one interest fee, the interest that is charged. There is a loan processing fee. There is the insurance fee, which can either be for the life or for the property. We have a stamp duty, and we have the legal fees. Let us look at the indirect costs that comes with the debt. Okay. There are other expenses associated with borrowing that may not be so obvious, and they include one like transportation to attend meetings or to go to the bank and fill in application forms. If you have to pay for this transport, or you have to close your shop in order to attend the meetings or to visit the bank and have the application process, these are indirect costs. So you need to be aware of the direct costs and indirect costs that of the borrowing or that comes with the loan package. Now you need to borrow wisely. Before taking the loan, consider how much do you need, okay, or the amount that you need. When do you need the funds, and how much can you afford? Okay. How much or the affordability will depend with your income, especially for the unsecured package, because there is an installment of that loan and there is your income. What is the installment that you pay for the loan compared to your income? It's normally called the installments to your income ratio. Okay. Also on the turnovers, if you're in business, then there is the installments to turnovers or your credits at the bank. So you need to know, you need to borrow wisely. You need to know how much you need to know when you need the funds, because again, if you get the funds and whatever you wanted to do has been passed by time, then you'll end up in debt, and you have to pay that debt in full. And if it will not have helped you, then it will be a waste of your time, your resources, and you'll also pay that loan with interest. So there are good uses of loan capital, which include the following, like purchasing inputs in bulk at a low price that will increase profits, or financing productive assets such as machines that help you improve productivity. For example, a water pump that enables an additional harvest, or food processing equipment that adds value to your crops. Now, purchasing an asset that makes a new business possible, such as a cell phone or a refrigerator, can be a good debt, or it can be it can be seen as a good use for your debt. Now let us look at 10 components of debt. Okay. Now let us look at the first one, documentation. There's some documents that you need to process the loan. For example, you need your ID, you need your PIN, KRA PIN, you need maybe utility bills. There's some documents like bank statements, or you need, if it's a vehicle financing, you might be called upon to produce a pro forma invoice or logbooks or the sale agreements. These are documentation that are required. Remember, different loans require different documentation. So you need to know the documents that are required for that loan to be processed. Then there is the TAT, and stands for the turnaround time. That is, you need to know from the time of application of the loan and by the time the loan amount is credited to your account or the disbursement, then you need to know how long will it take. This one will help you know whether by the time you get the money, will it meet your expectations in terms of you need that money by when, because you want to do ABCD. So the turnaround time is very important. Then you need to know the amount of money that you want. So you need to know accurately the amount, and also you need to factor in the deductions, the direct costs. For example, like the processing fee or the insurance. If that will be deducted from the loan amount, how much will be the net loan? Okay, so you need to know the net amount, or you need to know the exact amount you can apply for, and if you factor in or consider all the other deductions, how much will be the net loan, and will that loan be sufficient to for the intended purpose. Then you need to know about the tenure or the duration. For how long? Is it 1 year? Is it 2 years? Is it 3 years? Mostly for personal loans, maybe go up to 5 years. For vehicle loans, also scale, and asset financing goes also up to 5 years for main banks. Mortgages can be 10, 20 years, let's go up to even 30 years. So you need to know. Then the other element is interest. You need to know how much will you pay, or how much is the interest for that loan. Okay, and you need to know, you need to find out more about the interest and the type of interest. Is it a flat rate, or is it the interest rate on a reducing balance? Then you need to know the fees, that is the other fees that are charged, such as the insurance fees, the legal fees, the valuation fees. Okay, so if it's an asset that has to be valued, the valuation fee, how much do you pay? You need to be clear on all the fees that goes with that loan. Then you need to know the grace period. The grace period refers to the duration after the loan has been processed and you've received money. When will you commence repayments or making the repayments? So that is called the grace period, the duration between disbursement and your first repayment. And you look at the penalties. You need to be clear on the other banks or other institutions that have penalties like early loan repayments. If you had agreed in the initial contract that you've taken a loan for 3 years or 36 months, and maybe you want to pay it upfront after 2 years, what are the penalties? Okay, and in case of a late payment, what are the penalties? So you need to be clear on that parameter. Then you need to know, like I've talked about, the early loan repayment. Is it accepted? Can the bank accept early loan repayments? And if it can be accepted, are you charged? Are there charges? Okay. The other one is on the repayment amount. You need to know how much you will be repaying on a monthly basis. Okay. If the loan is to be paid on a monthly basis, if it's to be paid on a weekly basis, you need to know how much will I be repaying. Okay. So let us look at the factors to consider when choosing a lender. And the first one is the location. How far is the lender from your business or from your house? If this one will help you in terms of when you're making the repayments, and also the indirect cost. Maybe you have to travel in order to make deposits when you have to repay your loan. So the location is important. And the other thing is the type of loan offered by this institution. For example, a home loan. If does the bank, what type of loan do you want? Or what type of products does the organization or the financial institution, or what type of loans are they offering? Okay, because remember we have several, or we have quite a number of loans, like car loans, we have home loans, we have loan against properties, we have personal loans, we have education loans. So depending on what you want, it's important that you is important, because depending on what you want, you can maybe get that product from that bank. For example, like if it's construction, you can approach a bank that offers construction loans. Let's say like Henkel, we have the housing finance, we have Safe System Bank, we have KCB, among others. Okay. Then the other one is the customer service. Okay. How friendly are the staff working in that organization? Remember, service is key. And at times you look at service and say, I'd rather pay even more. But the kind of service I get here, I think I'm comfortable with it. So then you need to consider, it's important that you consider the service, the friendliness of the staff, courtesy, speed of service, the whole thing that goes with customer experience. What kind of experience do you get with that bank? Then there are several questions here that you need to ask the lender, like what type of loans are available. It's just highlighted that there are many different loans. We have car loans, we have mortgages, we have student loans, we have unsecured loans, we have secured loans. So it's important. For example, now talking of unsecured loans, if you're employed, you might find that some banks or financial institutions have better terms, call them group schemes, have an arrangement with the employer which greatly reduces interest and also gives more flexibility in terms of duration. You need to know how much are you looking for and how much can you qualify for. Okay, if you're salaried and you've gone with your payslip, how much can I qualify for? And then how much are you looking for? Okay, so these are two things. If how much are you qualifying, if it falls within your bracket, well and good. If you're told that this much you can qualify, then maybe you need to work on a savings plan in order to top up or supplement the loan. Then what documentation do you require? That depends on the type of loan, and as been discussed, as was discussed, the documentation required to have the loan process. Do you require guarantors or collateral? This now applies mostly for the secured loans. Okay. What are the saving or deposit requirements? This normally goes with the asset. You might be called upon to raise a certain deposit and the bank to finance, or the financial to finance the remaining balance. What is the interest rate? You need to be clear on the interest rate. Is it on a flat? Is the interest rate flat, or is it on a reducing balance? So you need to know the type of the interest rates, and also clarify on the type of the interest. How much is the interest and the type of the interest rates. What fees are charged? You need to be clear on the charges. Remember, we highlighted the fees as there is the stamp duty, there is the insurance, there is the valuation fee, there is insurance fee. So you need to be clear on the charges. Then what are the penalties for late repayments? In case you delay repaying, what are the penalties? Okay. What are the charges on early repayments? In case I make an early repayment, will I be penalized? Okay. So you need to be clear on all these conditions, or on all these parameters. And then how long does it take to get the loan? This is, we call this the turnaround time. How long does it take to get the loan? This one can be looked at maybe from also points. If you open an account, how long do you need to operate the account in order to qualify for a loan? And also, after you make the initial application, how long does it take to have the loan processed? So that one is also very important. Then how many times do you have to actually go to the loan office to complete the application? There's some loans that are done in bits. Okay, for example, like the mortgages. First you do the analysis, then the valuers will have to come and value the property. There's some the legal fees, the insurance charges to be paid. So how many times you need to know so that you can plan, because that's an indirect cost. It might not appear on the direct costs, but it's something that will affect you. You might find if it was not well planned, then can cause a hitch in your processing of the loan facility. What is the grace period given to start, or the duration given from the time the loan is disbursed to the time you begin making your loan repayments? So it's very important that you know how long or the number of days that you're given before you start making your loan repayments. What is the repayment amount and frequency? You need to know how much do I pay per month, and or if it's a loan that was advanced and was to be unstructured in a way that the repayments are to be done on a weekly basis, then you need to know how much to pay and how and the frequency. Now, are there debt restructuring possibilities? Yes, you need to know in case something happens and you're unable to meet the full repayments. Let's say, for example, you're terminated and the amount of deductions or the repayments per month, you can no longer cope or meet that repayment amount. Can you approach the financier and make some adjustments on the repayments? So you need to be clear on this, all these parameters. So these are basic questions that you need to ask a lender in order to get the information right, and also to be able to have a smooth flow in terms of getting the debt. Now, what factors affect your credibility, or if you are to apply a loan from a bank? So what factors can affect your credibility? One, insufficient turnovers or collateral, especially for business people, where we look at the bank looks at the turnovers, that is the credits, how frequently you deposit. Remember, the bank or the institution is able to know how your business is behaving depending on the number of, or depending on how your deposits and withdrawals are in your account. So if they are insufficient, then you might not be able to qualify for a loan. And also, if it's a secured loan and you need to have a security, or the amount to be advanced is pegged on the value of security or the collateral, then in that case you might not be able to qualify for a loan. The next one is fraudulent documentation. This is a criminal offense. Okay, we've seen people who have used fake documents, fake identification, fake ID, fake bank statements. So if for any reason the bank gets you, or you're known to have used fake documents, then that greatly affects your credibility. And actually now, the investigation, there is a section called the Bank Investigation Fraud Department that will be following you to make sure that that act should never happen again. So there is a window dressing. Window dressing can affect your credibility. There are people who know that now that they've realized that you need to have sufficient turnovers in order to qualify for a loan. So you make deposits just to dress the account. So you're making deposits and withdrawing Actually, some of them even make deposit and withdrawal at the same time. You find a client makes a deposit over the counter, goes to the ATM and withdraws the money, then comes back again, deposits and withdraws, in order to have more, or a list of more transactions. But if that is highlighted in your statement, then that can affect your credibility. Because the idea of looking at the turnovers is to show how the business is running, okay? Not manipulating in the account for the purpose of qualifying for a loan. The other thing is a caution list, or if you have a history or a bad history with the bank, then you are in the caution list. The bank may shy away from doing business with you, and in this case you might not be able to qualify for a loan if for any reason you're appearing in that list. Then credit reference bureau listing. If you are a defaulter, and according to the regulations, if you are a defaulter in any bank, then you list it. If you have a negative score, then that might affect your credibility. Unpaid items cited in your accounts. If you have like direct debits which are pegged on your account, maybe you were to pay insurance, or there's some payments that, or commitments that you set in your account, say maybe on this date make sure that you transfer money from my account to maybe another account X. So if for any reason that you have insufficient funds in your account and that date is due, then that item will become unpaid, and that will affect your credibility. Now, bounced checks issued by the drawer. If you write a check to pay for some goods or services, or to pay someone, and you don't have sufficient funds, that check bounces, and that affects your credibility. Because remember again, what you're doing is you want the bank or the financial to give you some money with the expectation that you will pay. So once the bank or the financier realizes that you have a habit of not honoring commitments, then that one affects your credibility. There's another one, that unpaid checks received by the drawer. If somebody gives you a check paying for some goods, and then that check bounces, if you have several of these checks, then if you're in business, the financier will see that you deal with unreliable people. Okay, and if the bank is to give you a loan expecting to be paid, and most of these people that you're dealing with are not honest, they are people who are unreliable, then that can affect your credibility. So these are factors, these are some of the reasons why you might not qualify for a loan, or might affect your credit score, or might affect your relationship with the bank. You might not be able to qualify for a loan if you have some of these things in your account conduct. How much debt can you afford? Okay, then that depends on the percentage of the installment to your income or the turnover. So that dictates how much you can qualify. Remember, there is like if you're salaried, for some organization you have to take home a third of your gross income. So the 2/3 will tell how much you can qualify for. Also on turnovers, or for the businesses, if they have a cut of 10%, you can commit 10 shillings for 100 shillings in turnover. That's called the installment to turnover ratio. So that will also tell how much you can qualify. Guarantors also. How much do you, how many guarantors? Okay. Or if the loan is secured, how much is the security required to guarantee that loan? So that will also affect how much you can afford. Just remember that any debt has consequences. You have to pay, or else then you're listed. Okay, you'll have a negative score, because a loan has to be repaid regardless of whether you have mishaps or you've terminated for employed people or your business is no longer operating. So a debt has to be repaid. There are two rules of controlling debt. Okay? So, but the best practice is don't borrow more than you can afford to repay. Okay? This also happens for people who have like window dressed their account. It's not that the turnovers reflect how their businesses are running or they are performing, but they've just manipulated the statement to qualify for a loan. And you find that at the end of it, all the business is unable or cannot sustain or cannot adequately service the loan repayments. The second rule is save regularly for emergencies. Okay, always make sure that you have an emergency fund account, because if you don't have an emergency fund account, in any case, or if an emergency comes, you go back to debts. Okay, you can avoid going into debts by having an emergency fund. What are the warning signs that the debt is out of control? If you've borrowed and there are warning signs that loan or the debt that you have is getting out of control. One, using credit to purchase things once bought with cash. If you used to buy or to pay your bills, buy food, or you used to plan and buy things in cash, and now you've gotten a point where you rely on debt, or you have to borrow in order to purchase something that you could have bought or you once bought with cash, then that's a warning sign. Getting loans or extensions to pay your debt. Okay, if you're like pushing loans ahead, no, let me not pay this month, let me just pay the next month, then that's a warning sign that loan is getting out of hand. Using your savings to repay the loans. Remember, when you took up the debt, it was for an intended purpose. Okay, that's where a good debt comes in, because it's able even actually to pay for itself. But where it reaches a point that you're using your savings to repay the loan, then that's a warning sign. Then using credit for living expenses, that's another sign. If you can't even sustain yourself to pay for the basic needs, okay, and some of the discretionary needs, then that's a warning sign that your debt is getting out of control. The common mistakes people do, people don't differentiate between a good debt and a bad debt. Okay? But remember, a good debt can turn out to be a bad debt if it's not well managed. Failure to understand the costs of a loan. Okay, you just take up a loan and you don't know exactly how much that loan costs in terms of interest rates, insurance, arrangement fee, valuation fees. So the costs of a loan, and also factoring in the indirect costs, which I've just mentioned some of the direct costs, but there are also indirect costs that need to be considered. Like you have to close your shop maybe to attend these meetings. That's a cost that you need to consider. The other thing is the risk of borrowing. Know that any loan or any debt is a risk, and failure to make the payments has consequences. And this, like, emergencies can come up, and you're unable to make the loan repayments. So you need to analyze those risks very well. You need to understand them so that you are able to prepare yourself for how you can make the payments in case something comes up. Wrong choice of a lender. Okay. Remember, we've looked at customer service. We looked at location. Okay. So and we've looked at the product offerings, or the type of loans that the lender is giving. If you make a wrong choice in terms of service, you might be frustrated. Might be very far where you have to close the shop and there are other costs involved. Or maybe you've chosen a lender that is not offering you the best. The other one is failure to understand the components of the debt. Okay, so we just discussed about the components. So if you don't understand these components, then that's a mistake, and you might have problems making the loan repayments. Now, where do you start? You need to know why you're taking the loan. Okay, the purpose of that loan. Okay, and if it's possible, you can save for that goal. Or if you're taking it, is it a good debt or is it a bad debt? You need to do a proper analysis of the loan that you're taking. When do you need the money? Then you need to know when, so that considering the turnaround time or the duration that the loan will take from the initial day or the first day that you fill in the application form, and by the time they give you the funds, you need to know, will that correspond or will that meet my expectation? You need to know where to take the loan. Is the right, when you're choosing a lender, you need to know the location, you need to know the type of product, you need to know the final details about the product offering, and you also need to know the kind of service that bank or that financial institution is giving you. So you need to know, how do you get that loan? Okay. Do I require guarantors, or how do I make the application? Okay. Can I do it online? Must I visit the financial? So you need to know all that. Which loan do I take? Which bank do I go to? Then you also need to know that. You need to know, how much do you want? Okay. How much do you want? When do you want? From which organization or from which lender? How can I make the application? Which type of loan do I take? So you need to analyze, you need to sit down, you need to do a proper analysis of the products and financial institutions, different financial institutions are offering. You need to work out within a budget, because you need that money within or by a certain date. Okay, so you need to be clear on all these components or all these parameters. They frequently asked questions like, what are the major risks of a debt? Okay, I begin by saying, a debt, once you borrow, you've entered the world of debt, and that debt has to be repaid no matter what. So there is a risk here. In case you borrow, an unexpected event comes in, like illness, or you're terminated from your employment, or your business collapses, or is damaged and you did not insure the business. So this is the risk that you carry with you when you're taking that loan. Then how can I tell that a debt is getting out of control? If whatever you used to pay in cash, you can no longer do that, you have to borrow, then that's a warning sign. If you're using your savings to pay up the debt, that's a warning sign. Okay. So we've discussed that at length, knowing that your debt is getting out of control. if you're asking for extensions or your loan to be extended so that you can have maybe some breathing space, then that is a warning sign. What's the difference between a good and a bad debt? A good debt makes income even in long run, in the long term. Maybe like a debt to do an investment, because an investment generates more income even now at your age of 50, 60, 70, 80s, or for future. So a good debt earns income. A bad debt loses value. Okay? And actually it's up the loan amount or even more. What's the difference between secured and unsecured loan? And a secured loan has a guarantor or a security pegged to it. In case of default, the financier comes in and repossesses the collateral, or has guarantors who come in, step in and make repayments. For unsecured loans, these loans are there's no security attached to it or any guarantor to step in and make the repayments. What are the consequences of defaulting a loan? If you take up a loan and you default, okay, if it is secured, then they will repossess the security. If they are guarantors, then the bank will approach the guarantors to make them pay the loan. And you'll be blacklisted, okay, or you'll have a negative score on your credit ratings. And currently is very harsh, because in Kenya today, if you default a loan, the loan earns penalty interest, okay, until the time that you make the repayment, unless either die or become incapacitated, permanent disability, then that loan might be written off. If you default a loan currently and you're listed, even after making the payments, and you will remain in that list of defaulters for the next 7 years. So remember, by that time, and remember that report can be accessed by any financial institution or any bank. So you will be grounded for around 7 years or so. But again, some other banks also accept if you make your payments and you obtain clearance documents, then they can consider you. But the fact is, there's a hitch, there's something at the back of your mind. Some of the reasons why you're listed, maybe the company you work for collapsed. But remember, it's a risk, and I say you have to pay. So it's very important when you're taking up a loan or when you're entering that world of debt, know that it has players, okay, and it has rules, and you have to understand the rules of that game, and you have to abide by the rules. So I would recommend this course to anyone who intends to take a loan, so that it can help you psychologically and know that the loan has to be repaid, and take it more seriously and make it a good debt. So to conclude this topic, this is the course for you if you're intending to take up a debt. So I hope this course serves you, gives you more information on the debt and how to what to consider when you're preparing yourself to take up a debt, and helps you know the consequences and how to manage risks, or know the exact or the types of risks that you're exposing yourself to. And this will help you, this course helps you manage yourself or manage your debts better and make them good debts. So this is the second module. I'll also welcome you to my second course on this second module called Getting Out of Debt. So if you're in debt, then there's still a way out. I'll help you understand or get to know more about getting out of debt. So thank you and God bless you. I hope you really enjoyed this topic or this course. God bless you. God bless you so much, and see you in the next video.